As I speak to you Wednesday afternoon in Asia, S&P futures are down about 0.9%. The proximate cause of that fall is an announcement made after markets at close Tuesday in the US by the world's largest chip company, Nvidia. They said they're taking a $5 billion charge on the export licensing restrictions of their H20 chips. Basically, they are saying that they're not going to be able to export those chips to China as they had planned. Is that new news? Actually, it's not that much new news. The $5 billion amount is new news. But we already had seen that the US tightening those restrictions on exports. Previously, the H20 chip was allowed because it wasn't the most cutting edge chip that Nvidia made, but that it was getting on the list of needing licenses to be exported to China. That was already known. And so what the announcement from Nvidia really means is that any hope of a reprieve, any hope that they would be given the license by the Trump administration has sort of disappeared, and they just feel like that they have to take that charge. Having just explained it that way, I think I should point out is nothing is ever 100% certain under the Trump administration. So although Nvidia is saying the situation looks pretty hopeless for shipping those chips to China, you never know. It could still wind up happening at some point. Now, when I explained the situation as it is right now to a couple of my colleagues, their reaction was, hey, if Nvidia's got to be down 6%, you're right, that news isn't really that new. That news isn't really that dire. I'm going to want to buy Nvidia shares. So maybe if those colleagues I spoke to are typical of the market, that sell-off we're seeing in the futures right now isn't going to come to pass, and we'll actually have an okay day on Wall Street today. My inclination is that the market will be down, and really it's not because the Nvidia news is worse than what I'm saying. It's basically because we've just had a big rebound in equity markets from last week. If you listened to my video last week, I was saying the S&P futures when I recorded that were down 2%, and I pointed out if stocks opened down 2% on Wall Street last week on Wednesday, that the S&P would be in a bear market territory. Today, if they open down 1%, the S&P will be down about 12.5%. So basically, in a very short period of time, in about a week, we've had a big rally in U.S. stocks, a big improvement, and it was more or less done with, I think, not a lot of conviction on the part of the investors. Of course, we had that very good news that Trump put in the 90-day reprieve on the big tariffs, but those could come back again. So I think a lot of people were buying, which to be honest is what I suggested last week, just on the fact that with the market down 20%, of course there's got to be a lot of bad news abounding, but it usually works out pretty well when you buy into a bear market. So people were just buying stocks because the stocks had dropped. They've had a nice rally. Now you have a piece of bad news. They're going to want to take profit today. So I think the market's going to wind up being lower today. Going on to the last subject I'm going to cover this week is the gold market. Gold is absolutely on fire. We're at a new record high. Last week when I was talking, I kind of said, the bond market is being unruly, and that was one of the causes of nervousness in the market. Fortunately, the bond market has settled down a little bit. Yields are actually a little bit lower than they were last week. And of course, you wouldn't expect yields necessarily to be lower with the equity market improving so much and people having maybe a little bit more optimistic view of the world. That tends to make yields go up. So to see yields drop when optimism is increasing, hey, that's a sign that the Treasury market maybe got over whatever was ailing it the week before. But one of the things when the Treasury market was acting odd is I had said, well, there were some rumors maybe the Treasury market was getting hurt by the Chinese selling their Treasuries. And I said, well, I don't think that's really the case, because if they sell the Treasuries, they have to do something with the dollars. And if they have a bunch of dollars, some of it would wind up in the gold market. And the gold market would just be on fire, which it wasn't at. It was last week. But of course, we've had a week of super strong gains in the gold market. I don't think it's because the Chinese are selling Treasuries and buying gold, but certainly it is a symptom that there is some worry about the dollar and the financial system. People are attracted to the safe haven of gold. So I think gold is something that even if you're not a gold bug yourself, you should keep your eye on, because if gold keeps going up, that's a symptom that something is not going quite right in the world, and those worries are going to creep back into the equity market and you'll see it drop again. So there's a lot of gold bugs that I meet here with KN clients and some of my colleagues. And so I hate to say, oh, I hope that the gold price is going to drop, because that's going to make people feel better about the equity market. But I think for the equity market to keep going higher, you're going to have to at least stop seeing these strong gains in the gold market. And it would be better to see the gold price drop a little bit as a sign of maybe a less need among investors to put money into safe haven assets. Anyway, that concludes my talk this week. I'll speak to you again next week.